Thanks everyone for coming by. So a few of you know us, a few of you look like you're new. Thanks for coming. There's three of us putting these events together. Myself, Anthony, Santosh, and Lane. Santosh and I are realtors. Lane's a mortgage broker. Just a quick disclaimer. Obviously, we're providing you that information, but before you make any decision, talk to a professional, right? And another thing I want to cover quickly, obviously, we've got people that have different businesses here, different industries. You're all welcome to come, but just don't promote your business, right? Like, it's a real estate event, so you can talk about real estate, but we don't want you to actively promote MLM or anything like that. So I'll hand it off to Lane. He's going to get us started with some really good stuff.
One of the other things to mention too, just for those of you who haven't been here, is we have a bit of a hybrid model. So we want this to be a meetup, like a networking event, but we also have a little bit of content at the middle. But instead of having a 3-hour, full of kind of us telling you stuff, we're 45 minutes, an hour at the most typically. But stick around after. We've left here at midnight before, so stick around after. Feel free to network.
Yeah, and just a heads up too, when we're done, we'll turn this into more of a networking event like we mentioned. So at the end of it, we'll just take the chairs away.
So one of the questions we've been getting asked a lot is that, of course, our market's booming. I think most people are pretty familiar with that. Prices have been going up, rents have been going up. So, and we've certainly seen that in other markets as well. And of course, those markets are starting to have to show signs of a correction. One thing to keep in, Toronto being one of them, Vancouver being the other one. So those markets have been going up for 15 years. Ours have been going up for 2, but we get a little bit more into the specifics as we get into that. At some point, a market that goes up where rent and prices go up way faster than incomes, eventually the numbers stop working. I just think we're a ways away from that, and we're going to get into some of that. So the two things that I watch the most are affordability, which is a very, very long-term cycle, and something that I didn't understand. I thought affordability would have to correct itself sooner, but it is shown in Canada not to, or it certainly is, I think, now. But in 2014, I remember giving a presentation. I was talking about how excessive the prices were in Toronto. Vancouver, it's always excessive as well, but Toronto too, specifically, their prices had gone up so much and so much faster than their income. And yet here we are, 8 years later, the prices were still continuing to go up. It went up 2.5, almost 3 times from that timeline. So even though they were priced, there's nothing to say that an overpriced market can't become more overpriced. So supply and demand is a short-term fundamental. One of the things that actually creates a lasting effect of an unaffordable market is if supply is shorter, demand is high. So in Toronto, they did a lot of different things: increased taxes and costs, restricted buildings, so a lot of kind of gatekeeping authorities at different levels of government administration made it hard to build. So supply was constrained. In Vancouver, they have real constraints. They have an ocean, they have mountains that are actually constrained geographically. In Toronto, they made a green belt around the city and said, we're restricted because of an imaginary line that we built. And then they also had other restrictions from all levels of government that made it more challenging. So tightened supply, and of course, massive immigration internationally for years really made that supply tight with a high demand. So it really propped up those unaffordable numbers. So people spent a long time, and I know this both statistically, but also anecdotally, we have clients that moved to Toronto, spent far more every year than they earned, but their net worth continued to rise. Every 3 or 4 years, they'd move up in their housing, and they would use part of the equity for the down payment, the other part to pay off the debt they'd accumulated. And that was a sustainable practice for a very long time. And, if you would have asked me in 2015, should I buy a condo pre-sale condo in Toronto, I would have tried to talk you out of it. And if I was successful, you'd hate me today because you would have doubled your money. You would have quintupled your money. The value actually doubled. And if you put 20% down, you would have made significant money. So supply and demand can make affordability, the realities of affordability, go way further than they should. So the thing that affects both of those things, mainly supply and demand, is jobs and economy. And I think that's where Calgary is doing really, really well. And it's really hard to really express that. There's a whole bunch of different things affecting that. So green energy, Alberta's by far the leader, not just per capita, we're the leader. So we have more green energy technology, wind and solar. Largely geographically, we also have an expertise and an educated workforce, but we have wind and we have more sunshine than anywhere else in the country. So agribusiness, obviously we're kind of the hub of the prairies, so we're getting the expansion that's happened there over the last 10 years. And film industry is 300% in 3 years. I think it's actually more than that now. A little tough to figure out where that's at with all the strikes that are happening, but our industry has grown. We all know the anecdotal different things that are being filmed here now, but that's been that industry itself has had huge growth. It's important to recognize that film is so small that a 300% growth doesn't really impact us all that much, but it's still another growth industry. One of the things that has helped us grow all of our industries is that oil and gas is no longer going to dominate the picture. So one of the things that every company was scared of, you move to Calgary, when oil prices are up, it's going to be impossible to find lease space. You're going to have to pay your administrator at the front desk $90,000 a year just to keep them employed, because the oil and gas industry had so much money for so long that it made the cost of everything go up. Well, even though we've had a big recovery in oil prices, we have not seen that same increase. Oil is now something that's seen as a, not twilight industry, but in a way it is seen by some as a twilight industry. So there's no big fear of oil and gas dominating and driving up costs anymore. So it's allowed a lot of other industries to flourish. Aerospace, this one doesn't even make any sense. Why would we manufacture? Why would we don't have an aerospace expertise. We're not in any kind of manufacturing hub. We don't have manufacturing workforce. None of it really makes sense. We do have an educated workforce. So de Havilland has decided that Calgary is the place to put their research and development and their manufacturing for all of their new airplanes. So we have I don't know if you guys have seen it, but just look up de Havilland and Calgary, and you'll see that they've moved their head office here, and they're planning a massive airstrip research and manufacturing facility just east of the city. So that shows that what that is we have a government that's business friendly, a workforce that's entrepreneurial. So all of those things were what drove. It wasn't some big $1 billion handout from our government too. They just saw the overall workforce, the overall government and entrepreneurial kind of background of this province as enough to actually move here and develop their industry from here. It's a long-term plan that's going to be there for 50 years. Logistics, we have probably the best airport maybe in the world, definitely North America. We have an airport that instead of being stuck in the middle of a city or up against an ocean, we have an airport that is surrounded by fields. So we can create logistics that go on forever around an airport that is designed for a city that's 5 times as large. FinTech, this is one of the surprises. Every city wants to be the next San Francisco. Of course, we all want tech. It's a big thing that every city's been trying to lure. The one thing about Alberta that it didn't have is the workforce. So even when oil and gas kind of left in terms of its dominance, and it left vacant real estate. So there's more vacant office space in Calgary than there is total office space in Vancouver. So a company can move here now and have very, very inexpensive real estate to go in, not just this year, but likely for another few decades. There's just that much space available. So that's going to be cheap for them. We have good tax rates, regulatory systems for fintech, financial tech related specifically, are a little easier to do business in. Things happen quicker here. So we had all of that, but we didn't have the workforce. And Anthony will allude to this a little bit more later, as well as some other tech stuff. But it's a lot of people, when we kind of corrected in 2015, they said, well, it's, Calgary's going to turn into Detroit. And it's a little different when you've got, third generation grade 8 educated factory workers versus our oil and gas industry, which was highly technical. So we had statisticians that already had math degrees, already understood coding because it was part of their job. And it was the hope was that they were going to be able to convert over to tech, which they did significantly. So we're now actually considered a highly educated workforce that has the capacity to bring more workers into the tech field. So we don't have that missing part of the educated labor that the tech companies need. Anthony's going to go over more of that, as I mentioned. So oil and gas. So this is the big one, of course. This has made up most of our industry. You'll see at the top, it says jobs growth. Oil and gas has counted for none of our growth since 2014. It was the last time we had any growth in our oil and gas industry. This is a chart. I wish I had a pointer here, but if you just look kind of up in between 2016 and 2017, so if you remember, oil prices kind of started crashing in 2014 at the end. So by 2015, there was no new capital expenditure going. So in between that area there, before the dip, so in 2018, we started running into a bottleneck problem. That's when we ran out of pipeline capacity. So the government mandated a slowdown at CapEx. So, and then of course we slid into COVID after that. So you kind of ignore that bottom part, but if you look from 2016, 17, and you come across to where we are now, where we haven't even really caught up to where we were in 2017 when oil prices had crashed. We're no longer a growth of production of oil province, we're a production of oil province. And we've laid everybody off that is really built for growth. We have some incremental growth, but it's very, very muted. So our growth has not come from this industry. CapEx has not gone up in oil and gas. So when people still tend to say, and you hear it in the media all the time, oh, Calgary's doing good because oil prices are up. And that has been the story for 40 years, but it's not the story this time. This is not where our growth is coming from. Oil and gas companies are not creating any of our jobs. It's great for the government royalties, like it is good for our tax base, but it has not been our economic growth. It's all those other industries, tech being one of the big ones. Again, Anthony, I'll get more into the details.
So yeah, like Lane said, very different story, right? From the usual cycles based on oil and gas. So I'll cover a bit more the tech stuff because I thought it was fascinating. So first slide I have here, you'll see Calgary doesn't show up, which is no surprise, I think, to anyone in the room, because Calgary is not that big of a tech city, right? These are mostly cities that we would expect to show up, right? San Francisco, New York, Seattle, like all the big tech cities. However, by growth, we're actually 12th in the world, which is rather interesting. And we're the only Canadian city to make the list as well in terms of growth. Now, that being said, going from 1 to 2 is easier than 100 to 200, right? Our tech sector is not that big, but it's growing really fast. And it's also not the first year that it's growing fast. It's been happening for a few years now. We had companies that wanted to come here, but they were worried that they didn't have a talent pool big enough to have skilled labor. Well, that's really interesting, actually, because in terms of skilled labor growth rate, we were second, just behind Vancouver, which also had a really high growth rate. We're talking about 60%, right? Again, smaller numbers, but still about 20,000 people extra in a single year just in the tech sector, which for a city the size of Calgary is actually really significant. So now we're seeing, the workforce match the demand that we're seeing from the industry. So it's really a growing sector. Another thing that kind of goes hand in hand with that is the remote work. And as you can see from that chart, obviously COVID, right, spiked up the remote work and kind of starting to plateau, it looks like, although it's hard to say because it's a short time horizon. But in either way, it's significantly higher, right? Like from that chart, it's way higher. And that's actually good for us because we are an affordable city, as we'll cover again later, a bit more in depth. So now someone that has a really good tech job in a more expensive city can remotely work and potentially move over here, right? And that's starting to be more and more of an impact for Canadian cities like Toronto or Vancouver, but even more so if they have a tech job, because not only they can keep the remote job coming here, but then they can also have the confidence that we have a growing tech sector. So if that situation ever changed with their company from Toronto or Vancouver, they could find work locally here as well. So next thing I'll cover, talking of people moving here, is the population growth to house completions. And that's a really interesting story for real estate investors in the room. Now, it's normal that the blue line is higher than the yellow line, right? Because there's more than one person per household. Always going to have more people than household, right? The average 2.3, I think you referred to later. However, we've seen like a huge increase of that, right? Especially this year, but it's been slowly growing up to that, where we have a lot of people moving in and our housing supply is not catching up, right? And it's going to take time for that to catch up, right? Because especially for a larger multifamily project, the intention to build and the actual finished product takes quite a while. Yeah.
What's making all the people move here?
Yeah, good question. There's a few things, right?
So
like Lynn covered,
jobs,
there's job growth, right? So that helps a lot. And affordability is another big factor, which we'll cover more in depth later. But Calgary is a very affordable city. And now, hand in hand with that, we also have the jobs to allow people to move over. And then, as I covered on the previous slide, a lot of people can keep their job because they have a remote job or at least ability to work remotely. Now they can move here, qualify for mortgage, buy a house, keep their job, right? So it's really pushing a lot of people to move here. Now that's a national level, right? So it includes also the international migration. And the federal government is also part of that, right? We had record high international migration, I believe 450,000 people yearly. Yeah.
So am I reading that correctly? In the 70s, we were building more houses than we are today.
Yeah, that's right. And that's national, but we also see that when we look at Alberta. So here I actually have the Alberta numbers, right? So we're in a similar situation, except it's actually even worse, especially for this year, right? The yellow line is really, really low compared to the blue line, right? And it hasn't risen as much as on the national level. So Alberta is also in that same situation. As you can see, as you mentioned, in the 70s, we were also building more houses than we were today, and the city was smaller. Like our population was much smaller. The second chart on the right is the per capita, right? The number of houses per population. And that also shows, right, we're starting to lag behind significantly in housing completion. So hand it back to Lane.
So this is, in addition to all the anecdotal stuff that we've all heard about people moving here, which I certainly have experienced, a lot of the buyers here that I know, and I'm sure you've all heard about it, is that we have lots of people here buying houses that are moving from Toronto, and they're keeping their jobs. They're keeping their jobs here because they can, instead of buying a 2-bedroom condo, they can get a big house with a big yard here. So they can raise a family, which is also something that employers like. So an employer likes to have their employees be able to buy a house, start a family, have their kids go to school. They're a more stable employee. They're less likely to move somewhere else. Whereas if they live in a condo in Toronto and they get a job offer at Boston that sounds cool, they can just, yeah, sure, what's stopping me? But if they've got a family, it's a little bit harder. So the employer likes to know that with the amount that they're paying their employees in whatever particular region they're paying them in, that they can actually go out and start a life, because it makes a far more stable employee. So these are the people that are predicting, this is recent ones, there's far more than this, but just off the top of my head today, I put this together. Stephen Pullis was here last week, and they were talking about I think ATB put something on, and he's former Bank of Canada governor is saying that Alberta is expected to outperform. ATB themselves has been saying that for a while. The Conference Board of Canada, actually, not Conference Board of Calgary. Conference Board of Canada says that Alberta is going to outperform. Sagen, which is formerly Genworth, does a lot of research. They're not only they had. I was at a presentation about a month ago, and it was an hour-long, basically slideshow on Canada, but it was basically the Alberta show. Everything was going to be, Alberta was taken out of context everywhere, saying, okay, well, this is what's happening in Canada, because he was talking about his reflection on where rates were going. Oh, but in Alberta, this is going to happen. And everything it's booming here. So we were going to outperform growth, everything. And then further to that, and this person is particularly from Edmonton, but they said Calgary's actually going to outperform. Calgary's going to outperform, has been outperforming Edmonton, is likely to continue to do that. All of those job sectors that we had up there most of that growth has happened. The tech industry is here. The de Havilland built their plant here. Most of the growth in new sectors is surrounding Calgary, not particularly Edmonton. Edmonton's always pretty boring and stable because it's a government town as well. But most of the new growth is Calgary based. And again, he's from Edmonton, so would naturally be biased in that direction, but basically admitted that Calgary is likely to continue to outperform. So again, we're back to, does this create risk? Are we in such boom times that we're about to crash? Keep in mind that our prices from the benchmark prices, which I think Anthony is going to show you later, his chart doesn't go back as the one that I have the one that I have shows from 2007 until 2021, and basically house prices were the same for the benchmark price. I'm particular to that 2007 date because I bought 2 houses, the one I live in and one of my rental properties. And in 2021, I don't even think I would have broken even yet if I would have sold them after I took out any renovations that I did. Now, I've made cash flow on them, but in terms of the value of that house going up, from 2007 until 2021, it was the same price. Now, there are neighborhoods that have outperformed, but certainly a benchmark is the same house being sold. The average house price has gone up because the average house price or a house is bigger. So more sales are happening, but when you look at benchmark, it represents this, if you bought the exact same house and then sold the exact same house or style or bungalow, 1,000 square feet, years later. So the benchmark is a little more accurate in terms of how much things are actually appreciating, not how many transactions are happening at a higher level. And of course, since 2007, we've seen interest rates, ignore the last year, we've seen interest rates do nothing but come down, so people could afford more house. So here specifically on affordability, we are the black line there. Canada as a whole is the red line, and Toronto and Vancouver the highest. If you look at, obviously we had a very expensive run in the late 70s, 80s when oil was first really discovered and they started dumping money into that industry. But when you look at what's happened over the last, 20, 25 years, our prices have become more and more affordable. And when you look at where we're at right now, we're in around the 40s. Montreal's about the same. And you can obviously, see the other, more larger cities. Now we're the 4th largest city in the country. And so these are the biggest four cities, and we're on the lower end of that, again, with a lot of prospects for growth. So in spite of the fact that our affordability has obviously gone in the wrong direction, if you're a buyer, 25% to, over 40, but we started at such a low base that even though we kind of follow the same trend as everywhere else in terms of how much more unaffordable things have gotten over the last few years, if you look at where we started from, it doesn't matter whether we're on the same trend. We have just such a higher room to grow. It's important to recognize that this is typically measured off of pre-tax income. So when you look at Toronto, or Vancouver, it's 100% of income. Now, of course, that's just taking the average home and the average price. A lot of people are putting more than 20% down when they buy a house, because they move from a house that went up in value too. So it's just looking at affordability for incomes versus the house price, not how much equity they might have brought into that house. But when you look at those stats, that's pre-tax income. So that's really high. Look, we have a lot of room to grow in Calgary before we even come close to where they were years ago, even 10 years ago. So even if we have a 50% increase in our prices, and the rest of the country falls back 30%, we're still going to be more affordable than. We have the highest income in the country, in Calgary specifically, and yet our house prices are, 80% below what Toronto house prices are, and probably 50% of what they are in Vancouver. So these are the recent stats. I've heard this one. I haven't actually researched where this number came from, but I've heard this a number of times recently. 1 home for every 9 people showing up in Calgary. And as we talked about before, we have 2.3 people per household on average in Calgary. So if we 4 times our construction, we'd be able to keep up with our current population growth. Now, even if we assume that was taken out of context because it was just a 3 months measurement of, very, very low construction and starts versus maybe it was the middle of winter, however they measured that, let's assume it's not that bad. It's half that. So we need to double our construction. Well, we have more tradespeople retiring than we have new people getting into that trades industry right now. So if we're able to pull off a 30% increase in our construction of residential real estate, it's going to be a miracle. We're still going to be falling behind no matter how high we do that, even though they are likely slowing the international migration and everything else, which is why I, even default to, even if it cuts in half in terms of our growth, we still aren't going to be able to keep up. We had a lot of shadow inventory for years in Calgary, leftover inventory from previous booms that was either rented or kind of vacant. And all of that's now been used up. And we don't have an industry that is set to build. Like, we don't have the tradespeople. They all went and got different jobs because there was no work for them for 7-8 years, because we had that excess kind of shadow inventory that wasn't necessarily listed on the market, but was there. So I think this is only going to further and it's going to take years to resolve. And I don't mean 1 or 2 or 3 years. I mean 7, 8, or 9 years before this resolves itself. So Canada's economic headwinds are actually really good for Alberta. What's happening elsewhere, and the fact that things are really excessive and falling off the peak, like we're starting to see cracks kind of leak into the system, which is going to impact rates. That's the big thing for us, is that even though we're booming, we have a little bit of cushion because they don't make decisions on what happens in Calgary. We're just not big enough or important enough for them to make a decision based on. So we do a thought experiment here. So just imagine, for example, that the average household income dropped 5 or 10%. So they made less money than we currently make. Right. Then imagine the average mortgage payment, so the average mortgage and the payment associated with that was 80% larger. So you make less money, but your mortgage payment is 80% higher. Right. Now imagine that your hockey team hasn't won a Stanley, or hasn't even been to the Stanley Cup Finals in half a century. Right. So now you know what people in Toronto feel like. So, and these are the actual statistics. Like, their mortgages are 80% higher. They make less money than we do. So as much as it's tough here right now, it's hard to get people qualified. It's just not what we're used to. And yet you look at their market, it's how do they get to that? But here's what is likely. So if you look at it, so 2/3 of Canada economy is consumer spending. That's pretty normal for a Western economy. We're higher because we depend too much on it. Over the last 8 or 9 years, we've become more and more dependent on consumer spending. We shut down our oil and gas industry and we replaced it with our ability to borrow and spend in the economy. But we're not actually producing anything. We're borrowing money we'll eventually have to pay back, or we can pay it back, or we can inflate it away, and governments like to the inflation route because it's easier. Although if they go too far with that, they pay a price. But largest consumers are young families. They're also the ones with the largest mortgages because they're starting young families. That's when they're at their peak spending. They don't have any savings, so they need big houses. So they borrow as much as they can. So the biggest consumers that drive our economy are also the people with the biggest mortgages. So when their mortgage payments double, keep in mind in 2020, so we're a year and a half away from when rates were 1.49% to buy a house. So people are getting $800,000 mortgages in Toronto to buy probably a townhouse, and it was 1.49. If they renew that, if rates stay the same and they renew that, they're going to be between 5 and 6. Well, 3 times the amount is 4.5. So even if it comes down to 4.5, that's still 3 times. So their mortgage interest is going to go up 3 times as much on an $800,000 mortgage. And they're not going to be able to refinance their way out of it like they've been doing for the last 15 years because prices will not continue to go up. In fact, they're showing signs of, they have been decreasing and showing signs that it's going to continue to happen. So the Bank of Canada, given that they know our consumer spending, it drives our economy and our GDP. They're watching this closely and a little bit scared of how to create that middle ground. They don't want more excessive spending because they have to stop it, but they also can't collapse the economy. They'd rather deal with inflation than deflation. So if in Calgary our house prices keep going up and we have crazy inflation and rents keep going up, they won't care. They just don't care about us. 1, because we're not large enough. Number 2, all the bankers making these decisions live in Toronto. So they're going to be surrounded by the chaos that they think is the most important and the only relevant thing. And that may not be good for a lot of people. It's going to be hard on people that live here, who've had it relatively easy for years compared to their cohorts in other big cities. But for us, it's actually good. It's going to allow our inflation, including real estate, including rents, to continue to increase. So largely it's good for us. Part of it is because for 15 years we didn't get a return. We're getting it all at once. But we've, I think that's given us a bit of a buffer so that as the market starts to kind of crumble backwards in the larger centers, they will have to ease up on in those interest rates. So we're not even a full year into the biggest of the increases yet. It seems like it's been years, but the increase, the last of the biggest round of increases, the last 50-point increase was December of last year. There's a couple of quarter points this year, but the big 75 and 50% increases all happened throughout last year. The last one being December. So it takes 5 years in Canada for all mortgages to turn over because most people have 5 years. Well, we're 1 year into it maybe. So by a year from now, we'll be 2 years into it, plus all the variable mortgages are going to start turning over to higher rates too. So in Canada, most variable mortgages, the amortization adjusts, the payment stays the same. Or they adjust it just enough to make sure that you're paying or covering all the interest. But people might still be in a 9,000-year amortization. They're not paying anything off. But what's happened is the OSFI, the regulator, has come out and said to the banks, if you're going to anything over 30-year amortization, you have to have more capital requirements, which puts the banks into either minimal or no profit. So now they're actually getting more aggressive with people to try and get them back into those lower amortizations, which will increase all the variable rates too. So by the end of this time next year, we'll probably have 60% of people. Currently we have about 23, we'll be over 60 this time next year of the people will have renewed their mortgages into those higher rates. So that's going to start impacting GDP, which again is 2/3 of our economy, which will then be enough for the Bank of Canada to start getting now worried about how bad it's going to get instead of how high we're going to go. That was my reminder to say what I just said. So that's how much it's increased. But obviously, I don't think enough economic data has come out pretty solidly showing that this is I don't even think we're going to have another quarter increase, which up until now, I was always worried about that. I can't even see them doing it now. Now it's just a matter of how long until they start dropping rates. I still think it's going to be a year, but the bond rates have already started dropping in anticipation of that. So fixed rates are going to start to get better sooner. But I think within 12 to 18 months, we'll see the variable rate start to drop as well. So that the fact that the rest of Canada is doing poorly is really a buffer for us, and it's going to allow our real estate and rent inflation to continue.
Okay, next up, we're going to switch gears a little bit, get to the actual stats in the current market, the real estate market here. So here we've got the benchmark prices here. So the year-over-year benchmark price has gone up almost 10%. And then you can see the different classes of properties, right? Detached, semi-detached, row house, and your condos or apartments. And you can see the trend here, the year-over-year growth is the highest in the row house or townhouse, followed by apartments, right? So mainly driven by the affordability component with interest rates rising. More and more people can only qualify for smaller amounts, so they're going for these smaller, more affordable properties. And migration, right? So a lot of people, when they move in, they want to look for an affordable product. These are a quick way for them to enter the market, right? Yeah, 3-bedroom, 2-bath type townhouses, yeah. In terms of what's happening, in terms of trends, so sales activity has slowed in the last month in Calgary. It's not a dramatic decline in sales, but it's starting to slow down, and part of this is being attributed to the seasonality. Typically, when we head into the winter months, sales start to slow down, and that's kind of what we're seeing at this time of the year. That being said, sales have slowed, but the inventory is still very low, right? We're still 18% year over year, lower than last year.
And last year was like 40% lower than the year before.
Yeah, I think we have the chart here. So here's the benchmark price by the quadrants, or the different zones. And what's most interesting is the northeast and the east areas, right? So your Forest Lawn and all your Martindale, Taradale, those areas, right? Yeah, it's all public data. You can Google Calgary Real Estate Board stats. You can find all these info. And look at the price growth rate, 16.7% here. And interestingly, Forest Lawn and surrounding areas, 20% year over year growth. And again, driven by affordability, these are the cheapest segments of the city, right, to get into a property. And a lot of immigrant population in these quadrants. So when immigrants first move into Calgary, this is where they end up, right? So that's driving the price increases as well. Okay, so total inventory levels, and this is an interesting one, especially in the last few years. So look at where we are right now. We're a little over 32, I believe we're right around 3,200 units of inventory. And last year we were already complaining in 2022 that inventory was terrible. Right? And this year it's even worse. So it's been a declining trend since 2020, 2021, 2022, 2023. Who knows if it's going to improve? Hopefully it improves because it's going to help everyone out. But so far it's not looking great in terms of inventory. So going back to benchmark price, we've got 5 major cities here: Calgary, Montreal, Vancouver, Toronto. And you can see the red and blue is Vancouver and Toronto, way up over here, right around a little over the $1 million mark. And Calgary is right here in the turquoise right there. So we're on a good path. It's trending up, but we still have a huge disparity, right? So we still have a lot of room to grow. Lots of people are coming into the city, so we anticipate a lot of there's a lot of optimism in Alberta and the Calgary market in general. Okay, yeah, with that, we'll wrap it up.